Senator from Maine.
Thank you, Mr. President. I rise today to speak on behalf of an amendment that I've filed to direct regulators to impose tough risk and size-based capital standards on financial institutions as they grow in size or engage in risky business practices. And I'm pleased to offer this amendment on behalf of Senator Shaheen and myself. Our amendment, Mr. President, is aimed at addressing the too big to fail problem at the root of the current crisis by requiring financial firms to have adequate amounts of cash and other liquid assets to survive financial crises without turning to the taxpayers for a bailout. It is critical to our ability to avoid future crises that this amendment be adopted. Mr. President, I'm very pleased that the FDIC Chairman, Sheila Bair, has strongly endorsed our amendment. In a recent letter to me, Chairman Bair called this proposal, quote, a critical element to ensure that U.S. financial institutions hold sufficient capital to absorb losses during future periods of financial stress. With new resolution authority, taxpayers will no longer bail out large financial institutions. This makes it imperative that they have sufficient capital to stand on their own in times of adversity, end quote. As Chairman Bair put it, this amendment accomplishes this goal simply and directly. It makes no sense that capital and risk standards for our nation's largest financial institutions are more lenient than those that apply to small depository banks when the failure of larger institutions is much more likely to have a broad economic impact. And yet, that is currently the case. We must give the regulators the tools and the direction to address this problem. If financial firms, including bank holding companies, were required to meet stronger capital standards, they would be far less likely to fail and to trigger the kind of cascade of economic harm that we have been experiencing since 2008. Our amendment would tighten the standards that would apply to larger financial institutions by requiring them to meet, at a minimum, the standards that already apply to small banks. Mr. President, this only makes sense. If a small bank fails, the FDIC can close down that bank over a weekend, allow it to operate, avoid a run on the bank, and deal with it in an orderly way. But if a large bank holding company fails, it is so interconnected in our economy that it sets off a cascade of dire economic consequences. That was a point that the chairman of the Banking Committee was just making. We live in such an interconnected global financial system now. So from my point of view, a view that is shared by the chairman of the FDIC, it only is prudent for us to empower the regulators to impose, at a minimum, the same kinds of capital and leverage requirements and restrictions that apply to small insured banks. Increasing capital requirements as firms grow provides a disincentive to their becoming too big to fail in the first place and ensures an adequate capital cushion in difficult economic times. By directing the regulators to establish capital standards that take size and risk into account, our amendment strengthens the economic foundation of large financial firms, increases oversight and accountability, and helps prevent the excesses that contributed to a deep recession that has cost millions of Americans their jobs.